Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content in Part 2 of why remote warehouses are a risky bet for modern investors. Let's continue learning more about long-term real estate success and smart location strategies. Labor is another major hurdle for remote facilities. Most people want to work near their homes to save on clothes, food, and gas. If a warehouse sits in a rural area, the local talent pool is usually very small. Companies then have to convince city dwellers to commute an hour or more each way. This rarely works for long, and it often results in high employee turnover. When a facility loses workers constantly, the owner faces non-stop training costs. New hires are less efficient and more prone to making mistakes. To keep people from quitting, remote tenants often have to pay much higher wages than the local average. This negates any savings they hope to gain from lower rent. If you invest in a building where no one wants to work, you will struggle to keep any tenant for more than a year. Wide distance is a deal-breaker for fast shipping. People no longer enjoy waiting a week for a box to show up. They want their gadgets, clothes, and groceries immediately. If a brand cannot provide lightning-fast shipping, the customer will simply buy from a competitor who can. A warehouse located far from a metro hub cannot physically keep up with this demand. No amount of technology can overcome the basic laws of physics and traffic. Imagine a customer orders a replacement coffee maker at 10 a.m. In a modern system, that item needs to be on a delivery van by noon. If the warehouse is 3 hours away from the city center, the truck won't arrive until 1 p.m. By then, the local delivery window has closed. The customer gets their package the next day, or even the day after that. This lag creates a poor brand image and leads to negative reviews. Eventually, the business loses its customer base to more agile competitors. Missing the window for same-day delivery. Logistics companies work on very tight schedules called cutoff times. These are the specific times when a truck must leave the dock to make it to the sorting center. If a driver misses this window by even 10 minutes, the entire shipment sits idle until the next day. Remote warehouses are at a huge disadvantage here because they have no margin for error. A simple traffic jam or a flat tire on a rural highway can ruin the entire day's schedule. In contrast, a warehouse near a last-mile hub can send a second-runner van to fix a delay. Distance removes your ability to be flexible, and in the world of shipping, flexibility is everything. Reduced resale value and tenant demand. From a real estate perspective, location determines the exit strategy for an investor. Smart money looks for properties that will be easy to sell 5 or 10 years down the road. Currently, the most desirable buildings are those located near major highways and urban centers. These assets hold their value because there is a limited supply of land near big cities. Remote warehouses don't have that same protection. If a major tenant leaves a rural building, finding a replacement is a nightmare. Most modern companies won't even look at a listing if it's too far from their primary customers. As an investor, you could end up with a vacant zombie building that actually costs you money every month in taxes and maintenance. High-demand properties near last-mile hubs are much safer because there's always a line of tenants waiting to get in. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.